As of today, August 3, 2026, the regular equity markets are currently closed, and Wolfspeed Inc., trading under ticker symbol WOLF on the New York Stock Exchange, recorded its last official closing price at $23.62 per share, moving up slightly to around $23.80 in early off-market trading sessions. While the broader Wall Street consensus is treating this silicon carbide specialist like a distressed semiconductor recovery play that might simply drift sideways until electric vehicle adoption re-accelerates, the actual order flow tells a completely different story. Behind the surface numbers, institutional volume has swung into hyperactive territory as traders debate whether the company can successfully pivot away from auto market weakness toward high-voltage AI server architecture and energy grid infrastructure. When you sit down and look at the actual tape, expectations for this company were grounded in a smooth, linear ramp of electric vehicle silicon. But the reality on the ground is a volatile restructuring effort marked by extreme capital intensity, factory utilization bottlenecks, and a massive shift in how capital markets price high-performance chipmakers. Over the past few weeks, retail platforms like Robinhood and interactive brokers have seen a noticeable surge in retail options activity surrounding Wolfspeed stock. If you open up the Robinhood app or sign into an interactive broker's trading account during market hours, you will see that the intraday swings on WOLF have been aggressive, moving between daily highs of $25.40 and lows of $23.33 on substantial daily volume of over 3.4 million shares. Many self-directed traders using active brokerage tools see the 34 RSI level and assume the stock is merely sitting in oversold territory waiting for a bounce. However, experienced market participants using institutional platforms recognize that the price action is being dictated by heavy short interest and macro sector rotation out of capital-intensive chip fabricators. Investors evaluating their online investment options across various investing sites often compare high-growth semiconductor plays to high-profile names like Nvidia stock, Apple stock, or Tesla stock. But Wolfspeed operates under a drastically different financial structure than those mega-cap giants. While Nvidia stock benefits from asset-light fabless manufacturing model margins and Tesla stock drives direct end-user automotive demand, Wolfspeed sits right in the middle as a primary foundry supplier of raw silicon carbide wafers and finished power modules. When electric vehicle build rates slowed globally over the past year, the market expected Wolfspeed's revenue to crumble completely. The reality, though, is that while recent quarterly revenue of $150.2 million missed headline estimates, the stock actually surged over 7% in the immediate aftermath of its earnings call, because management demonstrated progress in lowering cash burn and refinancing debt obligations. Look at how institutional money is currently positioning itself across major brokerages like Fidelity, Schwab, and SoFi. Investors utilizing automated allocation models like Schwab Intelligent Portfolios or SoFi Active Investing accounts generally see minimal direct exposure to speculative individual chip turnarounds, as these platforms weight heavily toward broad Fidelity ETFs or diversified index vehicles. But for traders managing an individual brokerage account or using active tools like SoFi Active Investing, Robinhood Stock Trading, and Interactive Brokers platform, Wolfspeed represents a tactical battleground. The contrast between expectation and reality is stark. Retail investors often expect a semiconductor stock down significantly from its historical peak to rebound instantly once broader tech rallies. The harsh reality of physical chip manufacturing is that multi-billion-dollar wafer fabs take years to reach optimal yield rates, during which underutilization costs directly drag gross margins into negative territory. Comment below how many shares of Wolfspeed stock you currently hold in your portfolio, and whether you are buying this turnaround or waiting on the sidelines for cash flow to turn positive. To fully grasp why Wolfspeed is experiencing such intense price volatility today, it helps to examine the underlying core business and how it evolved into its current form. Originally founded as Cree Inc. back in 1987, the company spent decades as a dominant force in lighting technology and blue LEDs. Over time, management recognized that basic LED manufacturing was becoming a low-margin commodity market dominated by overseas competition. In a massive strategic shift, the company sold off its legacy lighting business to concentrate entirely on wide bandgap semiconductors, officially rebranding as Wolfspeed in late 2021. The entire investment thesis was rebuilt around silicon carbide technology, which allows electronic systems to operate at much higher voltages, hotter temperatures, and superior switching efficiency compared to traditional silicon. The business model relies on two core pillars: selling raw silicon carbide materials and finished power devices. Silicon carbide is notoriously difficult to grow and manufacture compared to standard silicon crystals. It requires complex high-temperature furnaces and precise chemical vapor deposition. Wolfspeed positioned itself as one of the few global entities capable of producing these materials at scale, supplying both internal device manufacturing and third-party semiconductor companies. When electric vehicle makers shifted toward 800-volt electric vehicle architectures to enable faster charging times and longer range, silicon carbide became an essential component for power inverters. The narrative was clear: as electric vehicles grew, Wolfspeed would automatically print cash. Yet this is precisely where expectation collided violently with operational reality. Building out massive, state-of-the-art 200mm wafer fabs requires massive upfront capital expenditure. Wolfspeed poured billions into expanding its Mohawk Valley fab and constructing new materials facilities, incurring significant debt loads just as global interest rates began to rise. When pure-play EV demand experienced a localized slowdown and auto manufacturers pushed back vehicle launch timelines, Wolfspeed was left holding massive fixed overhead costs without the immediate revenue volume needed to absorb them. The result was negative gross margins and substantial quarterly net losses, which forced the market to brutally revalue the stock from a high-flying growth narrative to a high-risk manufacturing turnaround. For those managing their wealth through long-term online investing platforms, whether using Fidelity mutual funds, Fidelity IRAs, or self-investing options, understanding this balance sheet dynamic is vital. When you look at the balance sheet through Interactive Broker Schedules or Fidelity Trading Platform Research tabs, you notice that debt servicing and operating drain have been the primary drivers of negative sentiment. However, the company recently completed crucial refinancing agreements that extended debt maturities and provided liquidity runways. Management is actively redirecting production capacity away from pure auto reliance toward industrial power supplies, solar energy inverters, battery storage systems, and specialized high-voltage power components designed for next-generation artificial intelligence data centers. This pivot toward AI hardware power delivery represents a critical secondary driver that many casual investors are overlooking. After AI server racks require massive amounts of power, far exceeding traditional hyperscale data center setups. Converting high-voltage alternating current from the grid into direct current suitable for advanced AI processors causes massive energy loss if handled by legacy silicon components. Silicon carbide power modules offer far higher efficiency rates, reducing heat generation and power consumption in data center infrastructure. The market's expectation was that Wolfspeed was purely an automotive play tied to electric vehicle adoption curves. The emerging reality is that data center power architecture could become a primary growth catalyst over the coming years, helping diversify the company away from auto cycle risks. Looking at the immediate path ahead, the future outlook for Wolfspeed stock hinges on execution, yield improvements, and debt management. If the company can raise its 200mm fab utilization rates, gross margins will naturally trend back towards positive territory, driving significant operating leverage. Conversely, if high borrowing costs continue to compress liquidity and auto sector delays persist longer than anticipated, the stock will likely experience continued volatility and valuation pressure. Investors seeking investment help through Fidelity Wealth Management, SoFi Invest, or Schwab Intelligent Portfolios should evaluate whether their risk tolerance supports holding a company undergoing a capital-intensive operational transformation. The takeaway from analyzing Wolfspeed today is simple yet profound. Wall Street spent months treating this stock as a broken story bound strictly to electric vehicle trends. The reality is that Wolfspeed remains a primary owner of critical wide bandgap silicon carbide technology. While short-term operational headwinds, high capital costs, and factory underutilization have severely impacted earnings metrics, the underlying strategic value of 200mm silicon carbide wafer manufacturing capacity remains intact. As the company balances its debt obligations, expands to AI power infrastructure, and scales its production efficiency, the gap between market expectation and fundamental reality will ultimately determine where this semiconductor stock trades next.